So the 19th EU summit passed, and with some optimism that whilst key things were not negotiated at that summit, that steps were taken in the right direction, and as a result of that we have seen a continuation and a rally in most risk assets. Here we're including the European currency, and we're also talking about European stock markets. But since the closure of that summit, it's been fair to say that that thought process has begun to unwind, and unwind pretty quickly. We've had subsequent comments out from some of the minor regions of the Europe saying that we will not vote, or indeed will take each decision as it comes. And given that many of the votes will require not necessarily unanimous decisions, but certainly 80%, 85, 90% votes, it clearly puts a little bit of a spanner in the works, thinking that we've made that sort of progress. So as a result, we have seen some unwinding of some of that optimism. Interestingly, not in the stock market, but if we start with the currency, we take a look here at the euro. And we can see here that it got quite bearish towards the end of May. May was a very, very tough month, not just for currencies but for stock markets. But in fairness, June has been encouraging. We've saw a rally in the European currency during the first 2 or 3 weeks of the euro, the first 2 or 3 weeks of June, and that was indeed replicated in the stock market. But it's fair to say that as a result of some actions this week, we saw a 25 basis point cut in the interest rate in the ECB. Saw some interesting twists on that as well, a reduction in the deposit rate which the ECB pays out to banks. They were paying 0.25%, they've eliminated that to say that we're not going to pay anything now if you lodge money with us. What they're trying to do is force money back into the system and hopefully end up in the wider economy, although there's some scepticism that that will happen. So we saw some QE but nothing else, and there has been sort of increasing disappointments in some movements in Spanish and Italian yields. Again, we'll take a look at those charts in a minute. Net result is that the currency has come back, and as you can see here, it hasn't taken long at all to unwind all of that sort of reasonably good optimism that we saw in the first part of June to come back down to near that low period. 122.88 was the low that was struck in the euro. So currencies are down. The second area that has moved back and given up a lot of optimism, as I say, is back in these Spanish and Italian yields. You can see there that as a result of the EU summit, we really did see those tighten back in, but it's only taken a day or two this week to see those hurtling back up towards the high levels. And again, I think if we see a 7% print on Spain, then that is obviously going to impact on sentiment. It is fair to say that the levels of refinancings required in Italy and Spain means that the action is urgently required to try and come up with a solution before a lot of these rollovers are required, as I say, in the next 18 months. So the one market that, in all honesty, has been amazing that it hasn't been more negatively affected are stock markets. Stock markets around the world have held on to their gains, and these are the gains, as I say, that were experienced in the early part of June post that EU summit. But despite a small wobble, we're back up to the highs, and it's really defied a lot of what I'd suspect conventional thinking that maybe equities should be selling off as other asset classes are beginning to decline. But the fact that it's holding up is possibly making it all a little bit more intriguing. What is going on here at the moment? Well, I think there are one or two things that we should look at. This afternoon we will have the non-farm payroll, so by the time this podcast is published that number will be out there. So we're talking ahead of it. The consensus is 90,000 new jobs, so expectations are reasonably low. That's built off the back of April and May's rather poor numbers, but maybe a number could come in higher this level. I've heard comments that we may see some more important impressive numbers on non-farm payroll, and that definitely follows a number that I saw yesterday from the ADP that was well ahead of expectations. expectations, about 60% ahead of expectations yesterday. And if that is a good lead indicator, which it has proved to be in the past, then we may be in for a better non-farm payroll number. So our equity markets at the moment starting to look at a glass half full rather than glass half empty, and looking at that statistic this afternoon. Only, as I say, time will tell. But as I say, I will reiterate, I think equities have put in a very good performance this week. Now, I want to rattle through just a few other comments. First of all, take a look at the UK. Sterling, we saw this week no rate cuts, but we certainly saw an additional £50 billion worth of QE at the moment. I wouldn't be surprised to see further stimulus actions coming out, not necessarily from the Bank of England, but will we see the government take more actions? The government is at an intriguing point in its own political cycle here at the moment. It has stuck hard to the austerity drive, although I would argue that the debt numbers at the moment are not showing the progress that they would like to see it make at the moment, and so you could argue that they need to focus even harder on austerity at the moment. But there is no question that the current economic environment in the UK is much tougher than they planned for at this stage, and they are under some pressure indeed to try and stimulate growth. Will they do it? Will they spend some money? Will they build infrastructure? That is the question, and I suspect that they'll be thinking about that in the near term. If we were to take a look at one company's shares this week that I thought was interesting was Persimmon. Persimmon is one of the leading house builders in the country, and as we can see here, their shares are doing quite well at the moment. House builders are not doing too badly. Volumes of houses being built in the UK are still woefully short of the target, but house builders are very good at managing markets to adapt to different environments. And as I say, if there is a greater push to increase infrastructure spend in the UK, it may well be beneficiaries such as infrastructure plays, house builders, those sort of companies that could see some benefit. Finally, just want to cover a couple of other equities. It would be remiss, as I say, not to mention Barclays in light of what happened with the LIBOR fixing. We have spoken in the past about the potential lawsuit action, which creates a great deal of uncertainty into the stock prices. But again, fair to say that despite all of the news that was thrown against Barclays this week, the share price did hold up quite well, so leading some to conclude that we may be bottoming out. And just the final chart for me in the currency market. This looks an intriguing chart. It is the Swiss franc versus the euro. As you may be aware, the Swiss franc is in there protecting the value of the Swiss franc, or effectively trying to sort of reduce the value of the Swiss franc. There's huge demand for Swiss francs at the moment as a safe haven currency at the moment. Of course, that's making their exports incredibly expensive and impacting on their economy. So the central bank there has been in for what now appears to be most of this year, defending that 120 level. One just wonders how much that is effectively costing to keep that currency pegged at that level. So that's an intriguing looking chart.